Welcome to vTalkInsight, Allocator's Lens Daily for December 24th, 2025. Strong U.S. growth, ultra-low volatility, and record highs in both equities and key metals are colliding with mixed signals from inflation and global yields. For a cross-asset allocator, today is about weighing a Goldilocks soft landing against the risks of an AI-driven bubble, sticky inflation, and policy surprises across rates, currencies, and commodities. In equities, markets are riding a powerful mix of strong macro data and AI enthusiasm into year-end, but the leadership is narrow and volatility signals look very relaxed. U.S. growth surprised materially with third-quarter GDP running around 4.3%, helped by resilient consumer spending and better productivity. Real spending held up through the holidays, with inflation-adjusted sales up and car data showing 4 to 4.5% growth into November. That supports a soft landing narrative where growth slows toward roughly 2% year-over-year, but avoids an outright downturn. At the same time, inflation prints have mostly come in on the low side and unemployment has edged up, giving the Fed room to keep easing. That combination of decent growth, moderating inflation, and easier policy is the macro cushion under current equity levels. Global equity indices are holding around record highs, helped by renewed optimism in AI-related names such as Tesla, Micron, and NVIDIA. The VIX Volatility Index recently closed at its lowest level of the year, and recent S&P 500 gains confirm that headline risk sentiment is constructive. Under the surface, though, the picture is more nuanced. Returns have been heavily concentrated in large-cap technology and communication services, while mid-caps, transports, and small caps have lagged. Net positioning in equities has slipped back toward neutral despite the new highs, which suggests investors are participating but not aggressively chasing. There is also evidence of rotation. Cyclical sectors, including financials, industrials, and transports, are starting to show more consistent strength, and large-cap value has outpaced large-cap growth by more than 5.5% over the past 3 months. That kind of leadership shift usually reflects confidence in ongoing earnings growth rather than just multiple expansion. The center of gravity for this market remains the AI infrastructure story. Commitments for AI-related capital spending are estimated in the trillions over the next several years, and those expectations do a lot of work in justifying today's lofty price to earnings multiples. Companies like NVIDIA still face demand that far exceeds available chip supply, and there is strong order momentum for data center hardware and related infrastructure. Large platforms, including Meta and Amazon, are seen as well-positioned to monetize their AI investments over time. While some firms are vertically integrating energy supply, as illustrated by big technology players buying into clean and even nuclear power assets to secure long-term electricity for data centers. That said, high valuations bring genuine execution risk. Delays in large AI projects have already triggered sharp single-stock drawdowns, and there is growing concern that an eventual wave of sizable AI IPOs in 2025 and 2026 could test the public market's capacity to absorb new issuance at premium prices. Beyond AI, investors are re-examining more traditional equity income plays. Dividend strategies remain relevant if Treasury yields settle in a 3 to 4% range, since dividend growth has historically outpaced static bond coupons. Some high-yield dividend names now trade near 10 times earnings with cash yields between 4.5% and 6.5%, offering pockets of perceived value compared with megacap growth. At the same time, crypto-exposed stocks and digital asset proxies have underperformed alongside a 30% drawdown in Bitcoin, highlighting a more selective approach to risk-taking than the calm index-level volatility might suggest. With the VIX at cycle lows, market sentiment looks complacent relative to the number of macro and policy variables in play. From an allocator standpoint, key watch points in equities are follow-through on AI capex and profitability, the breadth of earnings growth beyond megacaps, the pace of any AI IPO wave, and whether low index volatility continues to mask growing single-name dispersion. Those dynamics will interact closely with the evolving rates backdrop. Turning to rates, the main tension is between very strong near-term U.S. growth and a policy framework that is already leaning toward more easing. Headline GDP has surprised sharply to the upside, with third-quarter output growing about 4.3% annualized. The engine has been robust consumer spending and a capex-heavy supply-side story that includes reindustrialization and narrower trade deficits. At the same time, year-over-year growth across the first three quarters is closer to 2%, slower than last year, and more consistent with a soft landing than a boom. Inflation signals are mixed. The GDP price index jumped to roughly 3.8%, above forecasts, suggesting underlying price pressures have not fully faded. Yet recent monthly inflation releases have mostly undershot expectations, and job gains are the weakest since 2019. That combination has supported a dovish tilt in the outlook even as markets stay alert to stickier inflation scenarios. The Fed has already delivered meaningful cuts since late 2024, and officials have signaled that keeping rates too high risks tipping the economy into recession. Markets broadly expect another 2 or 3 cuts over the next year or so, with many forecasters seeing the policy rate settling around 3.5% by 2026 if inflation stabilizes near 2.5%. At the front end, yields have fallen more than at the long end, producing a bull steepening of the curve. The 5-year to 30-year segment is seen as particularly informative, balancing sensitivity to Fed decisions with longer-term cycle forces. However, despite substantial easing, 10-year Treasury yields have actually pushed higher at times, reflecting upward pressure from global bond markets, especially Germany and Japan. Rising Japanese long bond yields and European fiscal concerns are feeding back into U.S. term premiums and making a rapid return to ultra-low long-term rates less plausible. Looking ahead, many fixed-income investors envision returns in roughly the mid-single-digit range over the next year, driven mainly by coupon income rather than large capital gains. U.S. Treasuries are increasingly viewed as offering reasonable value after recent repricing, yet global allocations to bonds remain relatively light, and around $7 trillion still sits in money market funds that could redeploy into longer duration assets. At the same time, long-term yields may not fall meaningfully unless there is a sizable rotation out of large-cap equities into bonds, because today's equity concentration is dampening natural demand for duration. In that backdrop, non-agency mortgage-backed securities stand out as an area where higher yields and improved credit quality are drawing interest. The housing channel also matters. A majority of U.S. homeowners remain locked into mortgages around 3 to 4%, while new 30-year mortgage rates are expected to stay above 6% into 2026. Existing home sales are likely to remain depressed, which limits prepayment risk in mortgage pools, but also caps the housing sector's ability to re-accelerate growth on the back of policy easing. Central banks retain significant optionality. The base case points to gradual cuts, but policymakers have indicated a willingness to move far more aggressively, potentially by several hundred basis points, if credit spreads widen sharply or recession risks intensify. That implicit backstop is one reason default expectations remain contained, and why rising long-term yields have not yet derailed equities. Cross-asset signals are sending mixed messages. On one hand, the S&P 500 has delivered strong gains even with 10-year yields holding above 3.5% since mid-2023, underlining that equities can cope with higher rates when growth and earnings are healthy. On the other, record-high copper prices and a still elevated GDP deflator point to upside inflation risks that could limit how far real yields are allowed to fall. For rate allocators, the focus now is on how upcoming inflation and labor data shape the path of policy cuts, how Japanese and European yields feed back into the U.S. curve, and whether any decisive rotation out of equities finally unlocks more substantial declines in long-term yields. Credit markets continue to enjoy a supportive mix of macro resilience, policy easing, and contained default risk, even as investors debate how much cushion is really left in spreads. With the Fed leaning toward a softer stance and long-term growth expected to remain near or slightly above trend, base case scenarios see only modest increases in long-term rates, not the kind of shock that would typically destabilize the equity market or trigger a broad credit event. Banks and asset managers generally expect corporate default rates to stay subdued, helped by earlier terming out of debt and still healthy interest coverage. That benign backdrop is encouraging investors to keep credit as a central portfolio building block, especially when expected total returns for high-quality bonds are clustered around 5 to 6%, and carry does most of the work. The more dynamic story is in private credit and leverage finance. Deal pipelines in private credit are at record highs, reflecting both strong confidence from private equity sponsors and solid growth in middle-market service companies amid high nominal GDP. As policy rates drift lower and inflation remains contained, financing costs are easing enough to unlock more transactions. In a leveraged loan market, merger and acquisition activity has accelerated as lower borrowing costs make buyouts more feasible again. Sponsors are even leaning into dividend recapitalizations, extracting cash from portfolio companies at a brisk pace. That behavior underscores high risk appetite and ample liquidity across the leveraged finance ecosystem. These trends support near-term returns, but gradually increase leverage in parts of the corporate universe, leaving the system more sensitive if growth were to slow sharply or if rates were to reprice higher. There are early signs of strain in weaker credits. One high-profile example is Saks, which faces a sizable debt payment within weeks and is weighing options including bankruptcy, emergency financing, or asset sales. Cases like this highlight that liquidity is not universally available, and that bottom-up credit work still matters even when index spreads look calm. Importantly, market participants believe the Fed stands ready to respond with more aggressive rate cuts if credit spreads were to widen materially or if recession risks began to climb. That perceived policy put reduces the probability of systemic credit event in many allocator scenarios, even if it does not eliminate tail risk. For multi-asset portfolios, this environment argues for close monitoring of high-yield and private credit spreads as early warning indicators, as well as attention to sectors where fundamentals are already softening, such as certain rate-sensitive areas of housing and consumer durables. In foreign exchange, the spotlight is firmly on the Japanese yen and the risk of renewed intervention. Japan's finance minister has issued unusually strong warnings about excessive currency moves, signaling a free hand to act in the market. That rhetoric has already pushed the yen stronger and lifted volatility across G10 pairs. Market participants believe authorities are especially sensitive if dollar-yen revisits the 158 to 162 zone, levels that previously triggered action in low liquidity conditions. Even so, real interest rates in Japan remain negative, and underlying fundamentals still point toward a structurally weaker yen over time. That's why many investors view the latest bout of yen strength as tactical, driven more by official job owning and positioning than by a durable change in the rate differential story. The U.S. dollar has softened against the yen on the back of these comments, but its broader role in global portfolios remains intact. Foreign demand for U.S. assets is still strong, and there is little concrete evidence of large-scale de-dollarization or of major currency pegs shifting away from the dollar, including in the Middle East. Solid U.S. growth, relatively high real yields, and deep capital markets continue to underpin the dollar's status, even as markets price in further Fed cuts. The cross-currents from global yield differentials, especially a slowly tightening Bank of Japan and a more cautious European Central Bank, will shape how far any dollar downtrend can extend. For allocators, this means FX risk is increasingly about relative policy paths and occasional intervention shocks, rather than a wholesale regime change in reserve currency behavior. Crypto assets are behaving like a high beta extension of FX and equity risk. Bitcoin is down about 30% from its peak and is negative for the year and crypto-related equities, such as exchanges and digital asset treasuries, have underperformed, partly reflecting risk-off positioning and potential tax loss selling into year-end. Structurally, though, the regulatory direction of travel is clearer. Coordination between the SEC and CFTC, including joint statements and roundtables, points toward a more unified framework for both traditional and digital markets. Many observers expect 2026 to be an important inflection point when greater regulatory clarity could unlock broader institutional adoption of tokenized assets and certain crypto products. That sets up FX and crypto as another channel through which policy and risk sentiment spill over and across asset portfolios, alongside more familiar rate and equity linkages. Commodities round out the picture with a striking divergence between metals and energy. Gold has notched its 50th record close of the year, reflecting a blend of expectations for further Fed rate cuts, heavy central bank buying, and heightened geopolitical risk. Demand is coming from both defensive and speculative channels, and the metal's strength stands out given how calm equity volatility appears. Copper has also surged to record levels, trading above $12,000 per ton in London. The rally is being fueled by mine outages, long project lead times, and trade frictions that have disrupted supply. Traders are front-running potential U.S. tariffs by moving copper and silver into the country, draining inventories elsewhere and widening the spread between U.S. and international prices. Beyond the immediate supply tightness, copper is benefiting from powerful structural themes. Reindustrialization, the build-out of electric vehicles, renewable energy, and the grid upgrades needed for data centers all point to sustained demand growth. Investors are increasingly looking at copper-linked equities as a way to gain exposure to these trends. Silver is catching a bid from similar forces, straddling the line between a precious metal hedge and an industrial input. At the same time, speculative activity in futures and options for both silver and copper has intensified, pushing prices higher even as some technical indicators look stretched. That raises questions about how sustainable current levels are if macro sentiment wobbles or if tariff headlines shift. From an inflation standpoint, record copper prices feed into higher industrial costs and can nudge inflation expectations higher, which matters for both bond markets and equity sectors with tight margins. Energy tells a different story. U.S. oil production has grown by more than 1 million barrels per day despite lower prices, keeping the global market well supplied and reinforcing a disinflationary tone from the energy complex. Against that, geopolitical tensions around Venezuela are rising. The U.S. has intensified its blockade of Venezuelan oil tankers, seizing vessels and cargo in an effort to squeeze the Maduro regime. Analysts see a high probability that these efforts will succeed in forcing political change, which keeps near-term geopolitical risk elevated and has led to short-term spikes in crude prices. However, Venezuela's current contribution to global supply is relatively small, and even a friendly regime would likely take years to ramp production materially. In parallel, AI-related power demand is exposing bottlenecks in electricity and water availability, prompting major technology firms to invest directly in clean and nuclear energy assets. That underscores how the energy transition and the data economy are increasingly intertwined, with implications for long-dated commodity demand and for inflation-sensitive assets across the portfolio. Stepping back, the cross-asset picture is one of apparent calm on the surface, but growing tension underneath. Equities are pricing a long-lasting AI and productivity boom in a soft landing economy, even as leadership remains narrow and valuations lean heavily on follow-through from capex and earnings. Rates markets see more Fed cuts ahead, yet long-term yields are being held up by global factors and by the lack of decisive rotation out of equities into bonds. Credit looks orderly with tight spreads and booming private activity, but isolated stress cases and heavy use of leverage show how quickly conditions could shift if growth disappoints or if volatility returns. In FX, yen intervention risk and a resilient dollar anchor the narrative, while crypto trades as a high beta sidecar ahead of possible regulatory normalization. Commodities complete the mosaic. Record gold and copper prices speak to both hedging demand and structural electrification, while oversupplied oil and Venezuela-related tensions keep energy risk skewed but not yet destabilizing. For allocators, the key is to watch how these stories converge. Whether AI delivers enough real growth to validate equity pricing, whether inflation stays contained despite fiscal and commodity pressures, and whether policymakers can navigate currency and credit risks without upsetting this fragile balance. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.